Swaby.
Swaby. Actually, good that you asked that beforehand, because obviously
I nearly said swabby in the head.
Everybody goes
Do
Swaby.
they?
Yeah.
Swaby, yeah. Welcome back to Lessons in Property with me, Steve Hand. So I'm excited today because I've got Josh Swaby with me from HTB, Hampshire Trust Bank.
Yeah, good to see you.
Good to see you too.
How's things?
All right, yeah. Have you got lots on?
Yeah, I mean, this time of year is obviously quite busy naturally, because obviously a lot of developers and a lot of clients are wanting the cash before Christmas.
Yeah.
Trying to get loans completed.
Yeah.
So it's very much a all hands to the pump sort of thing, and trying to get everything completed ASAP.
Yeah.
I mean, obviously developers all want the money as quickly as possible anyway. But I think that kind of end year does signify quite a significant milestone. So if they can get the cash before Christmas, and then they can move into January ready to either get started on site or to really start drawing on the facility and get it complete. On housing anyway, what would hopefully be sort of summertime, to then look to start getting some sort of pre-sales across the door.
Yeah, I was going to tell our viewers, of course, that HTB are involved in the whole journey, aren't they? So
yeah, correct.
Quite often developers will use a bridge to acquire an asset. Sometimes it'll go straight to development finance, of course, if it's got full planning, but sometimes they just go bridge initially, acquire it, make the necessary changes, then go to development finance.
Yep.
Sometimes development exit were required, which we can talk about in a bit, and then onto a term product as well. You even do the exit, don't you?
Correct, yeah. So yeah, I mean, that is kind of one of our sales points, is the fact that we do from sort of almost cradle to grave, in the fact that our bridging team can offer land finance, and so do the dev team as well. The only differential is that the bridging team will offer land finance on land that's got full planning, whereas my team will do land that's got actually outline, where they're looking to enhance the planning, and then obviously move on to the dev facility, whether that be residential or commercial, and then obviously dev exit on the back end, which is a little bit higher leverage possibilities rather than the resi side, which is quite normal in the market. And then obviously on the back end of that, should they want to retain them, because obviously dev exits, you typically tend to see them on the sale of residential assets. Yeah. Whereas then you flip it onto a term side, as a suggestion that obviously it's going to be investment. So we offer everything from start to finish, and there's naturally going to be a few sort of challenges along the way, but I'd say between the three teams, we are probably the most smoothly operating that we ever have been, especially from when I started at HTB 2 years ago. Obviously we've had a few managerial changes. Alex Upton has now moved from Managing Director of Dev Finance and Bridging to now being Managing Director of Specialist Mortgages and Bridging. And obviously we've got Neil Leach, who now heads up Managing Director of the Dev Finance team. So obviously in terms of that cohesion from across the teams, it's got a lot better, and now it makes it a lot easier to have cases where they are looking to do the dev and then move on to an investment side. It just makes the whole process a lot smoother. And from a legal perspective as well, it makes it cheaper for clients, because ultimately we already hold the debenture in the first legal charge. But that's in an ideal scenario. Not all developers kind of look at a deal and think, well, we want to do 3 stages with the same lender, because ultimately it can put a lot of eggs in one basket, so to say.
But they've got that option, haven't they? That comfort knowing that you can exit them out, providing that it stacks up at the beginning when you do your due diligence.
Absolutely, yeah. And we don't really, it's not something that we're in the market for, to analyse a deal on the back end. We always analyse the deal on the front end, because as we mentioned earlier before, we've got the camera on, the exit is key, and that's not just for dev team, it's for dev, investment and bridging. So ultimately when we do take paper further or to credit, we're always going to be analysing the exit first, and should that change along the way, then that's fine, but ultimately we want to make sure that we're not committing to a facility in a dev team that we can't ultimately refinance on a term side either. And again, that comes back to that sort of cohesion between the teams, that I know that I can pick the phone up to Wes Baker, for example, who heads up our investment team in the north. I know for a fact Wes would be able to take a really good look at a deal on the basis that we complete the development. Essentially I can provide the client with 2 sets of terms, obviously both indicative until fully credit backed, but at that point, from your perspective as well, it's good, because the client can look at it and say, well, actually, even though I don't need the term for another couple of years, that's the 2 options. So they're almost committed up front.
That's good. And of course, I remember a site that it was in Knutsford, not too far from me, that I sent to you guys. The client unfortunately didn't go ahead in the end. They lost the purchase, but you provided some excellent terms. We had a specialist lender that came back with a higher LTV, but then they charged for it significantly more as well.
Yes,
To the point where it was better to use your facility, your illustration, and have another investor come in. But this was a commercial asset, and what they were looking to do was demolish that and build 4 luxury homes on it. But because it was a commercial asset, not all lenders lend, of course, on a bridge against a commercial asset.
Yeah.
So it's worth making that point. A lot of lenders will only lend if it's a residential asset. Some, of course, will lend whether it's land or it's commercial. But the key difference between you and some of your competitors was that you were able to go to, if I remember rightly, 70% of the value with it being commercial, and the rate of interest was less than 1% a month. Whereas some of the other providers, because it's commercial, they load the interest rate, don't they, per month?
Yeah. I think that'll be from the bridging team as well, wasn't it?
Yeah.
Yeah, so that'll have been, as you said, less than 1% a month, and obviously on the commercial side we can bridge that. And then I suspect because of the amount of debt that we were proposing at 70%, as you said, I suspect back on the back end then they were just going to move it to term. But yeah, really good opportunity, and unfortunately it fell through because the purchase didn't go through. But that's kind of that happens very often, I suppose, where you get a lot of deals through the pipeline, but I suppose it only matters the ones that you actually get across the line and complete.
But very attractive terms, that's what I noticed. That
I appreciate that.
You're in that market, in that place where you'll lend across many asset classes, but not charge a loaded premium or an enhanced amount for that on the interest rate.
Yeah, I mean, ultimately as well, we are a specialist lender, so we're in the market for property, but it's specialist property, so we can't brand ourselves as a specialist lender and then only go for kind of bread and butter sort of ground up housing developments.
Yeah.
You know, we've got to explore and sometimes push ourselves a little bit further, even out of our own comfort zone, and challenge our credit committee on some decisions and make them deals that back the ones that we feel work. And obviously in that instance, it was definitely a deal that we could have made work. It's just in both bridging, development, and also term, there's many hurdles that you've got to overcome before you actually get to the finish line, unfortunately. But I suppose that's the aim of the game.
Yeah, and something that's just popped into my head on the dev side, we've got the usual metrics that a lot of developers are well aware of, where it's loan to cost, loan to GDV.
Yeah.
So we have these 2 major metrics, don't we, in the development world, where lenders are comfy, and it can range typically from 60 to 70% of GDV as the percentage, and then on the loan to cost side it might be 80 to 90 depending on the lender out there. But you've got this additional facility, haven't you, where it's like a mezz top up almost, and is that like private money or is that a separate fund, or how does that work?
The element of sort of mezzanine finance, we work with numerous sort of mezzanine finance providers. It's not an internal product that we offer, however we just have a good relationship with a lot of other mezz providers. So should we offer terms on a resi or even commercial scheme at 65% loan to GDV, or for example we go higher end at 90% loan to cost, essentially whichever is the lower, and the client would like to take an additional slice of equity up to, I believe, 75% loan to GDV, which is quite a significant portion.
Yeah.
Then we can start having them conversations with some of our sort of trusted mezzanine providers.
Yeah.
And it's almost a matter of following or replicating the same process that we go through, but for them it's on a 10% or even 5% slice, and should they be comfortable with the deal and they feel as if that there's sufficient profit in it for them, and it's a good opportunity that the client's going to proceed with, then we can look at sort of the 2 together. Obviously that then does spit out a blended rate, which can be a little bit more expensive than just sort of the senior debt.
Yeah.
But I suppose any developer that's needing that additional equity, I think deep down they're probably going to know that it will come at a cost premium anyway, because ultimately, even though it is only 5 to 10% on top of our senior fund, they're still going to be ranking behind the senior lender. Yeah. And it still
carries extra risk, doesn't it?
Correct.
So
yeah.
Naturally, it's got to be charged accordingly.
Yeah.
But it gives developers another option, because if they've got maybe a couple of projects, they're only thinking of getting into one, but there's 2 quite profitable projects on the radar, then how do they fund them?
Exactly.
Using either investor money or mezzanine finance, or it's just great to have that creativity, isn't it? And that additional way of doing it.
Yeah, and like you said, it also gives the developers an extra layer of flexibility. They can spread the cash, what they originally thought would be, a sizable sum for one scheme, a little bit thinner into 2 others. Yeah. And then, as you said, get mezzanine on one of them, or maybe even on both, but it enables them to do 2 schemes at once. Obviously, within the developer's experience, they obviously need to know as well that they're capable of delivering 2 schemes at once, because obviously that management element can be quite challenging. But there's many developers out there that would be happy to take on 2 schemes and, be able to manage them pretty easily.
Yeah.
As long as they've got the sufficient sort of infrastructure and project managers behind them.
No, great. So what does, I want to ask the question, what does an ideal case look like? But of course, I know your response is going to be, well, we've got such a big range. Because what's your loan range?
Our lowest in our dev team is £1 million, and then the maximum is 25 million. That's pretty much the same across the bank, aside from investment and bridging will go a little bit lower. And the only reason we put a cap on £1 million of dev loan is just because it's the market that we'd like to be in is specialist, but it's also quite niche. It's erring on the larger side if possible. Obviously the dev team do land as well, and for land deals I think we'll probably take a view and could look to go lower than that £1 million. But again, that's on the basis that we've got a good client and we're looking to support them, because ultimately the key for us is not just doing the deal, it's supporting the client. If they're
long term, isn't it, as
absolutely, yeah, it's all a long term play, because if we've got a good relationship with an existing client or even a new to bank client and they'd like to buy a piece of land and they've got a proven track record, then why wouldn't you support them with the land acquisition at 500 grand?
Yeah.
Because then when the planning comes in, it might be worth 750, 800, and then on the back of that, the residual land value is going to be really strong on a GDV basis. And ultimately, the client can walk away with, a strong profit margin and a funder that they can be comfortable is going to take them through each of the process, like we said at the beginning. So in terms of an ideal proposition, it'd be, I suppose, housing for us is our bread and butter.
Yeah.
We've always been good on the
Is there a
housing
sweet spot of units, like say 5 to 10 or 10 to 20? Or
I'd actually say it used to be around that when I started. The 5 to 10 range was probably when I joined HTB. I'd say now we're really pushing the boundaries in the fact that a good singular standalone bespoke housing development. For us, we've done stuff at 25, 30 units that's been really, really good. Very strong sales, quite niche, but again, really good developer, established location and good product. I think the reason being dev is quite challenging is that you could get a brilliant location, but if the project or the product doesn't suit the location, you're not going to get as much traction on sales. So you don't necessarily need one element of dev to be perfect. You just need all of it to be good.
Yes.
And I think that's the key.
Yeah.
And a lot of developers can get tripped up in, I want to deliver this and this, and I don't know, I want to give it like oak roof struts above the garage, and that adds quite a few sort of build cost onto what would be a rather achievable pounds per square foot build. You've got to be invested in your schemes, but there's been invested, and then there's probably putting money in when you're not necessarily going to get the value on the back end for the GDV.
You've really got to know your area, haven't you? Who's
Correct,
your end user? Who's your buyer? What location is it? It's not that you won't lend, say, out in the sticks. You'll consider city as well as rural, won't you?
Yeah.
It's just got to be the right product for that end user, and something that's not going to sit on the market for too long, I guess. No lender wants property just sat on the books, do they, where they're having to refinance them. I guess there's quite a detailed study done by the surveyor, of course, on the locality. Not just the sort of macroeconomic environment, but that locality, who's the client type, what is the range of properties that sell pretty quickly within that location. Yeah,
absolutely. We hosted our 3rd development finance masterclass a couple of weeks ago, and I believe some of your team came to the one that we hosted in Manchester earlier in the year. One of the really good pieces that I thought was Blaine from Pride. He delivered obviously a slide on there that kind of evidenced the difference, or even the benchmark in pounds per square foot build costs, and he showed a photo of each kind of living room, kitchen, bathroom, stuff like that. What we're saying is, if you're going to build an average product, that's fine, but the location's got to match that as well. It's got to be X, Y, and Z. And if a client's coming to you and saying that's what I'm going to build, and it's absolutely gorgeous, that's fine. But does the micro and even macro location support that? And that's ultimately one of the key points that we need to look out for in dev finance, even on the term side, because ultimately it's going to dictate the yield as well.
So on HTB lend across England and Wales, don't they? That throughout the whole of England and Wales?
Correct, yeah.
You're not sort of saying above Harrogate we can't consider, there's no, you're not prejudicial towards any part of the
we say England. We operate in England and Wales, so it's absolutely every corner.
Right the way up to what, Berwick upon Tweed, is it? Pretty much on the border.
Just as long as it's not past the border.
Different legal structure, isn't it, of course, as well. So, there's plenty of lenders that operate in England and Wales. But in Wales as well, throughout the whole of Wales. It doesn't matter if it's a bit more rural or...
Well, no, I think rurality does come into dev finance, especially even, Peak District and such like that, because we do see a couple of schemes where developers will approach us for, what will be buy-to-let or holiday lets. For us, that's challenging, and even for the value, it's challenging because a lot of the times they're so rural and bespoke that there's not been many comparables recently. And I think in that instance, it's important to take a commercial view and really to analyse the quality of the asset, because ultimately you can come across these bespoke holiday let developments that will be, a great success, but ultimately you're probably going to struggle to have any comparables to rely on because it's so remote.
Yeah.
And that applies for Wales as well, not just kind of more north of England. That's kind of the same scenario where you might have different schemes in and around Wales, and some will be closer to towns and more affluent areas, and others will be kind of somewhat rural or even semi-rural. And I think for us it's a matter of structuring ourselves not just on leverage but also on pricing and whatnot as well. It's all for risk essentially.
So whether you're lending on, let's say we're in Wigan, aren't we, so a terraced house, typical working class town, terraced house in the middle of Wigan, fine, you're okay with that for a new scheme that is a ground up development for that, or a conversion that was converting maybe apartments in the town. But you'll also look at the other end of the spectrum. Let's choose London and maybe Chelsea, something that's a bit more higher end, that's a lot more pounds per square foot. A conversion there, you'd look at that end of the market as well, and everything in between.
Yeah, absolutely, yeah. And and what I will say is we're not overly keen on singular assets or singular unit developments, purely because there's a lot of concentration risk in that one asset, in the fact that if it doesn't sell, then it's the entire facility that we are reliant on to support it until it does sell, and then we will receive full debt reduction, and then the client will also take their element or their slice of profit out of it as well. And should that sale be delayed, then obviously you're just cutting into the client's profit. So typically schemes above one unit is where we are at. The amount of units that we can go up to maximum is very much dependent on the capital values of each, because you could, something down south.
25 million.
Yeah. Essentially something down south could hit that 25 million quite quick compared to somewhere.
A couple of houses.
Yeah. Depending on what they're building, And, we will go right up the way to even more sort of innovative products as well. We've got a couple of developers that use ICF, which is Integrated Concrete Framework, and that sort of more innovative element of building, and stuff like that's very interesting as well, and it means that they can achieve an EPC of A's quite easily, because the net carbon throughout the development and the carbon thereafter that's produced is a lot lower, and then as a result we can also offer the green loan product that we do, which not many people are aware of because I don't think it's shouted about.
Do you know,
much,
we've got a very good client, it's popped into my head, that Isotech's his business, and again that's it's like traditional build really, massive in Italy, but it's not been so big over here. But you can build out at EPCA, and it's just making sure that the exit route is solid, so we've got all the lenders on board, because I guess you'd want to see that first. You might support a build like that, but you'll want to know that the end user can get mortgages on that product with that type of build afterwards.
Yeah, and obviously I think the challenge as well for the developers will be getting the warranty in place as well, because whenever you test new forms of construction, the warranty providers are going to be a bit more diligent and a lot more sort of hands-on with the development, to making sure that it's up to scratch at every stage or every step of the way. But our green product as well, just going back to the exit point, that is essentially what it is. It's benefit on the exit for the client. So a typical exit fee, for example, 1.5, it'd slash that by half, and that's just because the client can evidence an EPC of A. I think the mortgageability point is a question to be asked, but I think ultimately in this day and age we're already aware of a lot of the more innovative forms of construction that are in the market. So ICF, as long as it's done correctly and signed off, then they'll be able to get a mortgage on that. And even modular or net carbon emission. Unfortunately we don't do modular because there's quite a bit of off-site pipeline risk. It's something that I would love to get it more into, especially because you've got the likes of some really successful developers like, I don't know if you know Situ, which are in Leeds.
Situ, I do, yeah.
So they've done Kellam Island in Sheffield, and that's it's a very market-leading product. So for us, or for me anyway, personally, it would be great to support something like that. But for the time being, we don't do modular. But we are sort of on the not lower end, but kind of mid-range, where more environmentally sustainable forms of construction are coming through, and we're comfortable that they are going to be mortgageable and obviously saleable on the back end as well.
So moving forward, are there any areas that you want to get, besides what we've talked about, more into, or anything that you'd like to tell the viewers about that might make them think, yeah, HTB is the lender for me?
Well, I mean, yeah, like going back to what we said at the start, really, the key USP, as it were, for us is the fact that we can do everything from start to finish. You know, we are commercially minded as well. We're not kind of a one-size-fits-all. It's very much making the deal work for the client as much, or the funding package work for the client as much as it does for us. Somewhere that I'd like to sort of explore a little bit more is that ICF form of development. I think we have only got a small portion of developers currently on the book that build like that, and if we can support a few other developers that are going down that similar route, it can be very beneficial, because ultimately it's quite cost efficient and labour efficient. But yeah, I mean, in terms of our USP, it's very much you deal with the individual as well. I know for a fact we've got a quality team both in the north and the south, which is where our two offices are. You know, the people that you deal with ultimately the people that really make everything happen and make the deal work. So yeah, other than the fact that we are very commercially minded, and obviously we're in the market and we're pushing for growth, it's about that, who you deal with on a micro level.
Yeah, absolutely. And, looking to make a deal happen where it fits.
Yeah.
And if it doesn't fit maybe on one parameter, it's like looking at the whole piece, isn't it, and saying, well, actually, these 3 pillars are really strong, so we'll forego that other pillar that may be slightly weaker, because we can see the bigger picture.
Absolutely, and that's you know, I'm not saying that we're going to sign off on everything, but you know, we do take views and commercially look at different scenarios and different deals in every way, because ultimately in debt finance there is no such thing as a vanilla deal, as it were. It's all rather niche and specialist. There's always going to be something that you've got to get comfortable with, and ultimately as well, it's that thing of, if we do turn around and say, right, let's work together on this is how we think it might be a bit better, or you know, even if from where I'm sitting, if we decline a deal, I'm not going to just say, no, it's not one for us. I'll explain why we've taken that view and why it's probably going to be a challenge, and that won't just help the client as well, but it'll help yourself as well. So
massively. No, that's great.
Yeah.
Thank you, Josh. Thanks for coming on board.
Good to see you.
Yeah, good to see you. So that was Josh from HTB. Wonderful, amazing development finance, but not just that, bridging. We've got the exit, and we've even got development exit as well for you developers out there that might require funds a little bit sooner than waiting for all the properties or all the units to be sold. So hope you've enjoyed that. Until next time, bye from me.